31st December 2019. Like I said, that's the LIBOR rate. So I'll have two columns, very important. The first column is for our add-backs. So this is shillings and this is shillings. We are using the net profit approach. So we go back to our statement and get the final result the accountant had. And there was a loss of 890,400. So that's where we start. So we say reported loss. So reported loss is 890,400. Now don't forget, you must put the brackets for the loss, otherwise your figures will go wild. Then we bring in our add-backs. So where do we get our add-backs? We now take a good look, we scrutinize the items that went through the income statement, and we look for the few that are not allowed under section 16, the list in section 16. Now, since I'm looking at the first item, I talked about 4 items. So the first item was expenditure items. So items of expenditure, let's start from cost of goods sold in the trading account, because the trading account is still costs. And in the trading account, we are guided by a note. There's a note on purchases. Please look at note 8. Note 8 says, cost of goods sold includes purchases amounting to 178, 176, inclusive of VAT. We saw that. Now, the adjustment we need there is that VAT is a tax. It is not supposed to have been included. So we want the costs of goods, the purchases, without the VAT. VAT has been included. It is inclusive. So what we did, we said to get the VAT, it is purchases plus VAT. They've already added. Purchases is 100%. Plus VAT is 16%. If it's inclusive, it's equivalent to 116%. What I want to remove, what I want to add back is only the VAT element. So VAT element would be 16 over 116. I multiply by purchases that had included VAT, 178, 176. And I'm sure you know the answer to that. And we, of course, you can calculate that, but we have the answer we had obtained the other time. So the first add back was VAT included in purchase. It was calculated in that way, and we put in the middle column, if I recall correctly, it was 24,576. You can confirm. So that was the trading account. We are looking for expenditure items. Then come down to expenses. The first expense items given by the examiner was consultancy fees. Now the examiner did not give us any details on what that entails. So in a situation like that, please leave it. Don't start imagining. Don't make assumptions. Don't do that. So consultancy fees, just allow. So we will not touch that. The next item there is purchase of drilling machinery, which we agreed in the previous class was a capital cost. It should not appear in the income statement. These are capital expenditure. So just add back purchase of drilling machinery, and we add back 150,000. So purchase of drilling machinery. And we add back 150,000. Still in the middle column. The next item is drawings of goods by P. Dina. Remember, P. Dina is one of the partners. I did comment in the previous question, and I'll still make that comment here. In the list of disallowable expenses under section 16, you will not find payments to partners. However, here is the logic. A partner and the business are one and the same thing. So the business cannot pay the partners. It's like he's paying himself. When you pay yourself, then you call that a personal expense, a private expense. Tax does not accept private expenses. We separate between private and business expenses. So all payments to partners, including salaries, interest on capital, drawings, they'll be treated as personal and they'll be added back. So let's add back this item, drawings of goods by P. Dina. So drawings of goods by P. Dina. And we add back an amount of 80,000. Still in the middle column. The next item is interest expense, and we looked at note 3. It says 80% of interest expense represents interest on partner's capital account, which is paid according to the profit and loss account. Again, interest on partner's account included in the interest expense is a payment to the partners. Any payment to the partners is personal. It is non-business. So we have to add back interest on capital, on partner's capital, and we don't add back the whole interest, we only add back this 80%. And we did that math. 80% of 480,000, you can confirm, but from our list, we had something like 384,000, so you can confirm that. These are items you had already included, 384,000. Then, the next item is impairment loss of property. So the term impairment is an accounting concept. From tax point of view, from this other side, okay, of the mirror, impairment is not a cost, okay? So it's an argument from accounting point of view that an asset value it changed because of events that happened. So it was either undervalued, most likely, but this is not a cost per se. So we add back impairment, loss of property, we have added back 24,400. So impairment loss, loss of property. We add back 24,400. Still on our income statement, the other one is office partitions. Again, the same thing. Just like the machine, drilling machine, office partitions are assets. You put up an asset. You're supposed to give allowances instead of putting the cost, the actual expenditure. So we'll add back office partitions. We'll add back 16,000. Still down the list, there's an item called salaries and wages. And salaries and wages has a note. If you can look at note 7, it says salaries and wages include salary of 80,000 paid to P. Dina during the year. So P. Dina is a partner. He said all payments, any sort of payment to a partner is private. It is personal. So we add back salary to P. Dina. Again, salary of 80,000 is added back. Back to our statement, the last item there was general expenses, which had a note 4. It says general expenses include conveyance fees for partnership profit, 48,000, and 22,000 for installing borehole drilling machinery in the farm. They also have a separate business. Those are specified sources of income in the farm. Now, these two we explained in the other class are disallowed. First, conveyance. Anytime you see conveyance fees, it refers to legal expenses or legal cost for purchase of property. So it's a capital cost. The treatment should be the legal cost on buying property, a building, land, and so on, should be added on the cost of the building. You should not charge in the income statement. So we'll add conveyance fees included in general expenses, conveyance fees on property. We add back 48,000. Stop. So an exchange of bit of batteries there. hope we are back. We're okay now. So we've added back conveyance fees for property, then 22,000 for installing borehole machinery. Again, this is called an incidental cost. Incidental cost incurred on purchase of machinery is added on the cost of the machinery, so it's also a capital expenditure. So we'll say here installation of borehole machinery, and we add back 22,000. So this is where we had reached in the other class. So if we do the math, some of you had already worked it the other time. Now those who are joining us today can confirm the figure, but the figure was given was something like 828,976. That's where we had reached. But, well, those who are there can confirm and comment. In case our figures are not correct, we can correct that. Now from here, we go to deductions. So deduct. So under deductions, we will go to what we call specified sources of income. We look at items of income, see whether there are adjustments we can make on income. So what's our first income? Sales. And they're saying sales is inclusive of VAT. Now, same treatment. VAT cannot be included in sales. Okay? So it means sales was overstated. Okay? So the correct thing is let's deduct VAT included in sales, and the treatment will be the same as we treated purchases. It will be 16 over 116 because it's inclusive times the figure of sales. Please work out that and give us the figure. So VAT included in sales to be the same thing. 16 over 116 we multiply by our figure of sales is 997,600. So that amount will come here and deduct and say VAT included in sales. So are they giving us the numbers? 137,600, I'm told. So 137,600. 137,600. That's okay. That's correct. So that's sales. We are still looking at incomes. There are other incomes, other specified sources of income after gross profit. Of course, gross profit is from trading, so we'll not bother with gross profit. The first income there is called unrealized foreign exchange gain. So what is foreign exchange gain? Foreign exchange gain is gain the business realizes because they dealt in foreign currencies. Say you imported stock at, say, in dollars, and the payment is supposed to be made later. And maybe because of fluctuations in exchange rate, the company makes a gain because they benefit from the exchange rate. The exchange rate is in their favor. Let me explain. Let me put figures to that. And I explain here the matter of foreign exchange gain so that you can understand how it comes about. So we have foreign exchange gain. Let me call it forex gain. Suppose you import stock and this stock, say, it was imported in the month of March, and the exchange rate was in the month of March, $1, $1 US was exchanging for Kenya shillings, say 105. Or let me put 102 in the month of March. Now, this stock was imported on credit, okay? On credit, is going to be paid later. So, if the imported goods worth, say, dollars, 1,000 US dollars, then the debt owing as at March is 102,000. That's the debt owing, 102,000. Let's say by April, the exchange rate is now US dollar 105. Now, because of the exchange rate, now the debt is 105 Kenya shillings. Shillings 105. So our debt is now 105,000. So the stock of goods we bought in March, when the exchange rate of 102 was valued at 102,000. But by April, it's now valued at 105,000. Let's say by May, $1 by May is valued at say 101, just for purposes of illustration, 101 shillings. Now the debt in May was 101,000. Now let's have a look at these three different dates. Now in April, the accountant like you realizes that the exchange is now 105,000. So he will go to his books and say take note of a loss, recognize a loss of 3,000 shillings, because their debt as at the time of buying stock was valued at 102,000. But at the time of, by April, the debt is now 105,000. They'll report a loss of 3,000, but it is unrealized. Why do we call it unrealized? Because the settlement date has not yet reached. So they've not experienced the loss. They've not yet experienced it. But let's say the date of payment is May and the exchange rate is 101,000. So when they bought, the value of goods was 102. Now in May, the value of goods is now 101,000, which they settle. They pay at 101,000. They've benefited out, they've realized a gain, a foreign exchange gain of 1,000. That 1,000 is taxable because it's realized. So there's a difference. So in April, the settlement date has not reached, so the transaction is not yet complete. So they cannot recognize that loss of 3,000 is disallowable. Even if it was a gain, we can't allow it. But in the month of May, that foreign exchange gain of 1,000 shillings is supposed to be taxed. Now, having that in mind, let's look at this specified source we have here. They are calling it unrealized foreign exchange gain. Because it is not yet realized, it's like the middle date of April. The transaction has not yet happened, so they don't have that gain as yet. So we deduct it. So we'll deduct unrealized foreign exchange. Unrealized foreign exchange gain is 16,320. The next specified source there is called interest on drawings. Now, interest on drawings come about because the partners signed a deed. They said, in case any of the partners takes cash out of the business, they have to pay with interest. This is the interest we have here. However, this is not a trading income. It's not one of the sources from the business, so we deduct it also. Interest on drawings. On drawings is not a trading income, so let's deduct interest on drawings, 40,000. We're still looking at the sources. The next source is called dividends from Weber Cooperative Society. Again, we have to separate them. These are different sources. So deduct dividends from Weber Co-op. Now this again is a different specified source, so we deduct it. Then there's a reduction in provision for bad or doubtful debts. This one needs a bit of explanation. Now, whenever the examiner does not tell you that a provision is specific, it is valid. It is implied that the provision must be general. So this is a general provision. For the simple reason, the examiner did not say it is specific. So we are saying the provision was reduced. So this provision was created by transferring income from the income statement into an account called a general provision. The year when it was transferred, it was disallowed. What do I mean? I had said from the beginning some of the expenses that are not allowed for tax purposes include general provision for bad debts. For the simple reason, it's say where the accountant says, can you provide 20% of the total debtors which are unlikely to pay? Now we call that a general provision. What we allow is something specific like, can you provide for company X Limited? Because company X has been declared bankrupt, so the debt is irrecoverable. So there's a difference. So here is a case of a general provision that is now being reduced. The point to note here, the account you are reading, okay, the account we are reading to reduce was already disallowed. It has already been taxed because a general provision account is not allowed. So in the year it was transferred to that account, we added it back under this list. So it was taxed 100%. So because it was taxed 100%, when you reduce it, you can't double tax it. So we are going to deduct this because it's an item that is already taxed. So deduct, reduction in general provision, reduction in general provision for bad debts. And that reduction was 14,000. So we've gone through the items in the income statement, but we are not done as yet. The reason we are not done is because of note 2. There's a cash book there, which if you recall, the examiner said was totally omitted. We need to have a look at that cash book. It says, the following cash book summary was omitted, was totally left out from the business records. Now, my interest for now is with the expenses that should have been deducted, but the accountant omitted them. You get them in the credit of the cash book summary. The first expense is called electricity. But let's be careful a bit. Below the cash book, they said all payments in the cash book summary were inclusive of the VAT. Remember the concept of VAT, 100% plus 16%. It's inclusive. So it's 116%. Okay? So if electricity is inclusive, this time it was totally left out. What I want to deduct is the cost, the 100%. I think I need to put it down so that it's clearer. So these were expenses that were totally left out. So I'll take like electricity. So it's still the same concept. 100% plus 16% is 116%. However, nothing here. The whole amount was not included. Now I'm interested in the cost, which will be 100% out of 116%. The cost of electricity. So the expense will be 100 over 116. I leave out VAT because it's not allowed, times the electricity expense of 55.68. Please work out that and give us the cost which we need to deduct. So electricity, $4,800. So the figure is 4,800, which is correct. We will do the same for stationery expense. So stationery. So again, we are looking for the cost of the expense. So it will be 100 over 116 times 11,600, and the figure is we are being given 10,000. So again, electricity. Is 10,000. The next item is purchase of motor van. We all know by now that a motor vehicle will be an asset, a capital item. So we are supposed to provide wear and tear allowances. Now, this is my suggestion on the procedure. So when you have items or assets, my approach would be I will leave out items of capital allowances and work them out at the very end. I don't want to mix up capital allowances in the middle. I want to work them out all at once. So you can adopt my approach or you can work them straight away. Both are correct, but I would prefer that. So please allow me to leave motor vehicle for now. Then we'll put all capital allowances. We'll deduct all of them at once. So I'll leave motor vehicles. Payments to creditors is not a cost. That's already done. It's part of what we've captured as purchases in the trading account, so leave that. Then you have legal expenses. We'll do the same thing. For legal expenses, we want 100 over 116,000. Sorry, over 116%, we multiply by this figure. For legal expenses, 348,000, and we'll get how much? So I'll say legal expenses. How much? So you're getting 100, we divide by 116, we multiply by 348,000. What are the answers? 300,000 is correct. So 300,000. That was legal expenses. Purchase of neon sign. Neon sign is an asset. We'll do the same thing. Let's leave out capital assets. We'll work out all capital allowances at once. Then you come to donations. Now, even though the examiner said all transactions were inclusive of VAT, where applicable, for donations, it is not vatable. What it means, donations are exempted from VAT. When you donate, you don't charge VAT. So VAT for donations will not work the formula. We'll just bring the cost of 100,000 for donations. So I'll say here donations, 100,000. So far, we've deducted all the expenses we are required to deduct except capital allowances. Now we want to deduct all capital allowances at once. And well, I think I'll use the upper part. We already know the figure. For additions is 828, 796. So I can just bring the, let me bring the other items up here. Because of space, there's a question. Okay. Pauline has a question about donations. Now, donations are allowable, it's only that there are conditions. These were allowable with effect from the year 2013 when you make donations subject to conditions. For example, you must make donations where you don't benefit. For example, you cannot donate to an organization where you sit on the board of directors or your wife sits on the board, or it's a family, for example, NGO. Then when you donate to a charitable organization, they'll give you an exemption certificate, meaning the organization must have been registered as being for, you know, purposes of alleviation of poverty, for purposes of, say, providing education, or for purposes, you know, for charitable purposes. So what I'm telling Pauline, in essence, donations are allowable. It's only that there are conditions that must be met for donations to be allowed. Now, normally, when the examiner tells you donations, just allow it with the understanding that donations are allowable, unless he gives you additional information which can assist you to make a decision not to allow. So where the examiner has not given you reason to disallow, please just allow. But where he gives you additional information and says exactly where the donations were given. For example, if he says the donations were made to a private school, then he has given you a reason not to allow. But if he doesn't say, give you any reason to disallow a donation, just let donations go through because they are allowable from the year 2013. Very good. Yes. Good. Yes. Now we go to capital allowances. So capital allowances now will be granted on any capital expenditures that were in the question. So let's first go to our statement of income, the one we were given. In the statement of income, sorry, under expenses, there are office partitions. Now, office partitions are supposed to be granted wear and tear allowances under class 4. The rate of wear and tear allowances under class 4 is 12.5%. So I will straight away bring office partitions here. So we'll say WTA is short for wear and tear allowances for office partitions. The rate is 12.5% of 16,000, which will give us how much? 12.5% of 16,000. Any answers? 12.5% is the rate of wear and tear multiplied by 16,000. That was office partitions. Will give us how much? 2,000. So under deductions, wear and tear on office partitions, 2,000. Then we come to note 2, the assets that have been left out. We want to give capital allowances. First, there's motor van. Remember, the expenses in note 2 were inclusive of VAT. So we'll be doing two things. Before we grant wear and tear for motor vehicles, which is under class 3, the rate is 25%. We'll first make sure that we only take the cost without VAT. The cost is 100 over 160. So wear and tear on motor van, they call it motor van. Wear and tear on motor van. First of all, the rate of wear and tear is 25% class 3, then 100 over 116. The cost of the motor van was each 12,000. So how much is the wear and tear? 175,000. So again here, 175,000. Then going down in the cash book, there's the neon sign. Neon sign comes under class 4. The rate is 12.5%, the standard rate. So neon sign. 12.5%. It was also inclusive of VAT, so 100 over 116. This one is 232,000. So any figures for that? Wear and tear is how much? Are they giving a figure? 25,000? It's 25,000, yeah? Yeah. 25,000 from Lucy. Yeah. 5,000. So with that, we are ready now to have our adjusted profit or loss. So we already had additions. Our additions were this figure here, 828,000. Now I want us to add the items, the deductions. So the add backs are 828,976. The deductions from here, we add all this plus this one's on top here. Yes. There's a question about drilling machinery. Now, I talked about specified sources of income. You will notice that their incomes have not yet touched. If you look at the debit of the cash book summary of the cash book, you're going to see there's incomes like farming income and rent. That means I will work them separately, the way we had talked about earlier. We had said specified sources of income that are not from the partnership trading business will be worked out separately. The drilling machinery was installed at the farm. So it will be worked, we will use it, or the wear and tear will be deducted from the farming income. So we'll do that shortly. VAT. Okay. Under the list of disallowable expenses, which was section 16, you can maybe check it or have a look later because it's just a few items. I think they're about 16 or 17 the list under section 16. One of the items talks about taxes. So taxes are not treated as expenses for the business. Why? Because I don't need to incur tax to generate profit, but I need to pay salaries, electricity expense, rent, and so on. It's after I've obtained profit, then I can pay my taxes. So normally, if you recall, VAT is not put as part of the income statement. There's a separate VAT account where you debit VAT on purchases, you credit VAT on sales, and you balance off that account. You get VAT payable maybe by the end of the month, which you remit to KRA. So we have to separate all taxes from what we are doing here. So you done with the questions? Okay. So please add the deductions. We have the add backs. Now we want to add the deductions from 137,600 up to 25,000. We want to that list. We want figures for that. 874,720. Who has given us that? Okay, Marian. Okay, I'm told this is 874,720. This is a deduction, so you make sure you put a bracket. Now, we want our adjusted partnership, profit, or loss. Now, how do we get it? We have three items so far. We already had a loss of 890,400 in our statement. Then we have add 828,976, deduct 874,720, and we want the final figure. It will be your adjusted profit or loss. So three items. You start with the loss, negative 890,400, add our add backs. Total was 828,976. Our total allowed deductions are 874,720. The final figure is our adjusted profit or loss. So what's our final figure? Negative 936,144. So 936,144 is our final figure, and it's negative. So we are done with the first part of our adjustment. So now we have adjusted partnership loss of 936,144. That is the first part of the question. So do you have any questions on that? Okay, now we can quickly move to the second part. So 936,144 negative is what we want to distribute to the three partners. There are now three: S. Baraka, P. Dina, and Ominde. Now, I want you to remember something I was asked at the tail end of the last class. I was being asked about this statement. Those are statements at the end, note 9. Profits and losses accrued evenly throughout the year. Now, this is when we will apply that. Because when we are distributing, we shall keep in mind that between January and June, we had only two partners: S. Baraka, P. Dina. Then, from July, we are joined by Ominde. Okay? So, that is. Just a minute as we exchange the battery. It only take a minute. Okay, we are back. So we want to prepare the distribution schedule. We will be keeping in mind, January to June, we have 2 partners. From July to December, we have the 3rd part. So let's prepare for part B. So this will be our part B. So this is the B part. We are doing the distribution. Distribution schedule. So the partners are S Baraka, P Dina, for me they must have had another name, but it's okay. Then we'll need one important column called total. So you must put the total column. Now, what we want to display here is all payments that were made to the partners. Okay, so the first payment we want to make to the partners are salaries. And salaries, we have been given that information in note number 7. Salaries and wages include 80,000 paid to P Dina. So it's only one partner that has salary. So we'll say here salaries. But now we will split the item of salaries. Just a minute, I need to split this. I'll say the first 6 months. 6 months, okay? And then the next 6 months. So the first 6 months, the total will be half of 80, because we are told, note 9, all incomes and expenses accrued evenly or equally. So half of 80,000 per year is 40,000. Now that payment was all for dinner. Then the next 6 months, the same thing, 40,000. It accrued evenly throughout the year. 40,000 and 40,000 is 80. Now all that belongs to dinner. So dinner here, 40,000. So we have already distributed salary. So that's distribution of salaries. The next item we want to distribute, which were given in note number, was it note 3, is interest on capital. They said it's the 80%. So we'll have interest on capital. Again, the same thing, 6 months. 6 months. The first 6 months, the interest on capital, which was 30% of 480,000, we are debited in the P&L was 384,000. We'll take half up to June. Half of 384,000 is 192. So half is 192,000. Interest on capital. The other half is 192,000. The question is, how was interest on capital paid? We'll go back to the question and see how interest on partners' capital was paid. Note 3 says 80% of the interest expense represents interest on partners' capital account, which was paid according to the profit and loss sharing ratio. So what is the profit and loss sharing ratio? We get that in note 1. The partners shared profits and loss equally. That is S Baraka and P Dina. So the first one up to June will share equally between the first 2 partners. So equally means half. Half of 192,000 would be, is it 96,000, something like that. 96,000. That's up to June. We've taken half. Interest on capital for the whole year is 384,000. Up to June, it accrued equally throughout the year, is half, 192,000. The profit sharing ratio was equal between Baraka and Dina. Good. Then the same statement, note 1 says, the profit and loss was changed to 2:1:1 after Ominde joined. So our new profit and loss sharing ratio is 2 + 1 + 1, which is 4. So Baraka still gets 2 out of 4, which is half. Half of 192,000 is still 96,000. Sorry, I just stepped on the cable, sorry. Half of 192, 2/4 is half, is 96,000. 1/4 for Dina. 1/4 would be 1/4 of 192,000. We have answers. A quarter of 192,000 would be 48,000. This is 48, and this will still be a quarter, 48,000. And we've shared interest on capital. What else will be there? If you recall our format for distribution schedule, interest on drawing was supposed to appear here as an expense on each partner on a personal level. So I'll bring in interest on drawings, which was a total of 40,000. So I'll bring in interest on drawings. Again, 6 months. For the first 6 months, for the whole year it is 40,000. So up to June, if it accrued equally, it is 20,000. And remember, interest on drawings is an expense, so I put it in brackets. It's an expense. Then the next 6 months, another expense of 20,000. Then we have a big question. How will the interest on drawings, or how will we determine how much to charge each partner on interest on drawings? Because the examiner did not tell us that. You'll come to situations like that in the exam room, where you have to think very fast and find your way out of the situation. Like this situation now. The examiner did not say how much drawings each partner took so that we can distribute the interest on drawings. So it was up to the examinee to think very fast of a way out. Now, I know if I ask, how would you would maybe share interest on drawings, there'd be suggestions like some people might suggest, let's use profit and loss sharing ratio. Some people could suggest that. Others might think of other alternatives. Now, in this case, we cannot use the profit and loss sharing ratio for the simple reason this is not a profit. This is a cost. The partners are supposed to pay the business. It's a cost. So you cannot use the profit and loss sharing ratio. So I want to put the question to you, to the class. If we cannot use the profit and loss sharing ratio because this is a cost, what would you recommend, or what would quickly come to your mind on how we can share this cost? Please, can I have your responses on that? What would you suggest? Or if you're in this exam, how would you share this cost? It's not a profit, so we cannot use the profit and loss sharing ratio. What would be the alternative? what would you propose? Any response? What would be your idea if you're in the exam situation? Capital contribution, capital contribution. I think those are wonderful suggestions, and I would totally agree with you. This is the logic. Here's the logic. You cannot allow a partner to take out drawings more than what he has paid in. So you'd most likely restrict how much a partner draws based on how much he has paid in. So we are going to use capital contributions. So capital contributions for the first two partners are in note 1. Is it on note 1? Not note 1. They're earlier, at the beginning of the question. Baraka contributed 300,000 and Dina contributed 200. So we can use the ratio of 3:2. So 300,000 plus 200,000 is 5. So you'll get 3/5 times the first 20,000 will give us how much? 3/5 of 20,000 for Baraka. That would be like, any answers there? Three-fifths of 20,000 would give us something like 12,000.